Well, salacious, huh? That's definitely me. That's definitely economist for 35 years. You know the yeah, I've been a professional economist for almost to the day, 35 years. And the technology back when I started my career was that was the bright shiny thing, was the Pentium chip. Does anyone remember the Pentium chip? 286, 386, 486, and Pentium. Remember that?
Yeah.
And the thing about the Pentium was it allowed, because prior to that, everyone was on the mainframe, at least in my world of economic forecasting. And the Pentium allowed us to really go off on our own. And I started a company in 1990 based on the PC.
Yeah.
In interstate banking, that was the time of interstate banking. And I remember I had a compact computer. It was a portable, but it was like a suitcase.
Yeah.
And it had a little green screen, and when it did calculations, it would shake. It would shake. And that was the bright, shiny.
Yeah.
Yeah.
We used to send messages back and forth. This program that was really innovative that would let you send a file from one place to another place electronically.
Oh, yes.
And you had to get on the phone with your colleague in the other city.
Yeah.
And you'd say, 1, 2, 3, go, in each place.
Right.
And then you'd watch these little dots go across the screen for like an hour and a half
Right.
while the file moved from one city to another.
Right. You know, we're going to dive into.
So we're old.
Yeah, we're definitely old. Yeah, definitely old. And we're going to dive. I was going to say not that old, but we're pretty old. I'm pretty old. I was trying to think back to the first time we met.
Yeah.
And I might not have the exact first time, and I don't know if you remember this, but I think you were helping J.P. Morgan set up the J.P. Morgan Institute.
No, I think we met before that.
Did we?
Yeah.
Oh, okay.
During the GFC.
During the yeah, of course.
Yeah.
During the GFC.
Yeah.
I do remember that conversation though, because we were with Jamie Dimon,
Yeah.
and this is Chatham House rules, I think.
Yeah, it's all closed press.
Yeah, right. And he ends the conversation with kind of an open-ended question about, what can J.P. Morgan do to improve the world? That was my interpretation of the question, kind of open-ended. And I said, maybe you should do more FHA lending. That was a big mistake. That was a big. And I could see you like squirming in the corner. But anyway, on to the meat of the matter here. You've been doing a lot of thinking about AI.
Yeah.
I didn't realize until preparing for this conversation with you, you've given 3 speeches that I know of.
Yeah.
The Council on Foreign Relations back at the start of the year. Mm-hmm. And then you were in Reykjavik, and you gave a speech there. And then last week, I think it was last week, right?
Last week.
Yeah,
in Singapore.
So you've been really thinking, quite deeply about it. And you use the words AI is a, quote, big deal. It's a big deal.
Yeah.
And it feels like it's, I really want to begin the conversation with what's going on now. And are you as surprised as I am as how quickly AI has come on and to affect the macro economy, the broader economy?
Yeah, I mean, I think the transformations that are happening within artificial intelligence have been happening at a very rapid pace over the last 3 years. Artificial intelligence has been around since the 1950s. It's been slowly progressing over time. And then really when ChatGPT went live in 2022, in November, really exactly 3 years ago, really an amazing transformation has been happening through the use of large language models, and generative AI is a subset of AI. And when I check in with the sector quite regularly, and one of the things that's amazing to me is kind of every 6 weeks or so, there's a significant advance in the technology. So then there's the question, how fast does that get translated into the macro economy? And that's been slower, but it's starting to have a significant effect. And my anticipation is in the coming years, it will increasingly accelerate. So I think right now, the thing that we're seeing is big effects on business investment that is contributing to significant gains in GDP. We're not yet seeing that translate broadly into changes in productivity in the economy, changes in the labor market. I think those are to come. right now it's really the big investments in artificial intelligence and data centers.
If you go back to the start of the year when you gave that first speech to the Council of Foreign Relations, at that time, it didn't feel like AI was going to come on in terms of even the investment, right? I mean, we were talking about data centers and we were talking about what the power companies would need to do and the chip industry, but really, this seems like it came on so much more quickly and it has been a much greater tailwind to macroeconomic, at least GDP growth.
You can see that in the curve of capital investment in the sector. It's going like this. So it was, reasonably strong 22, 23, 24, 25. It just has been taking off. And it's not only equity investments, it also, credit markets are now deeply engaged in supporting the AI sector. So instead of just being equity driven, you're also seeing, significant debt following.
The other kind of channel that through which AI is impacting the economy that also very deeply surprising to me is through the surge in equity prices. You could, for these large AI companies. You can see NVIDIA came out with earnings yesterday and it's up, I was just looking, it's up 5, 6, 7%.
Right.
Just since yesterday. And that generates a lot of wealth, right? I mean, last I looked, the value of all stocks held by Americans is up $8-9 trillion in 1 year, compared to this time last year. And economists have this concept of the wealth effect. If you're wealthier, you tend to spend more. You can spend more.
Right.
And that's also driving a lot.
We're seeing that in the economy. You can see, higher income households are spending a lot more than lower and moderate income households, and they're spending at rates that are helping to sustain very strong consumer spending overall for the economy, which is supporting GDP growth, which is supporting jobs. That wealth effect is meaningful. It's also, partly house prices sustained that, and then, as you said, significant wealth in the stock market is also contributing to much stronger consumer spending and GDP growth than you'd otherwise would see.
Yeah, it's gone a long way to offsetting the drags from tariffs and immigration policy, right? I mean, those things are what economists would call negative supply shocks, and AI is a positive supply shock.
Absolutely.
Right, and if we hadn't had that surprising AI supply shock this year, we might be in a very different place from a macroeconomic perspective.
I think that's exactly right. I mean, you would have seen the tariff effects and the immigration effects pulling down potential output and output quite a bit. And you do see this AI shock pushing in the other direction.
Right. Now, most of the growth, though, has been, it's just GDP, it's output, right? Investment spending, consumer spending are part of gross domestic product. But we've not seen it in jobs, right? I mean, we got a jobs number this morning for September. It was a little bit better, but there was downward revisions to previous months. So since April, really, we're not seeing any kind of job growth.
That's exactly right. We've seen quite muted job growth every month, really, for the last 7 or 8 months. And that's an area of concern. Now, partly that's been offset by a decline in the labor force, so immigration has come way down, and labor force participation has also come down over time, although it did pop up a tenth in September. But those factors are reducing the labor force, so we're not seeing significant increases in unemployment, even though we're seeing lower payroll numbers, because the break-even number, the number at which we're creating enough jobs for people entering and staying in the workforce, has gone down a lot. So we're at about break even, a little below break even for the last several months. You see the unemployment rate tick up just a little bit. We are in an economy that on net is not creating a lot of additional jobs right now. And some people wonder, is that artificial intelligence showing up?
Yeah.
It probably is a bit. There are many other factors at play. I do think if you look at, some research has suggested that if you look at job sectors that are exposed to AI substitution, that in those sectors, entry-level hiring is lower. So, you've heard many young people worried about the labor market, and there's some evidence that it's showing up in some of those sectors. It probably is not yet showing up more broadly, in terms of labor market outcomes. But my expectation is that in 2026 and 2027, we're likely to see more significant effects of artificial intelligence. And then the question is, how do we manage through those effects? I think long term, I'm quite bullish that artificial intelligence is going to be really good for the economy and for the labor market. We'll see some jobs that go away, where AI is substituting for that labor. But we're going to see many jobs where AI changes the tasks within an individual job, and the person doing that job is going to be massively more productive. And that's going to mean they're going to be able to demand higher wages without inflationary pressures, and that's good. And then there's a third category of things. There are going to be jobs created that you and I have never heard of. Right. And people are going to look back in 30 years and say, well, why was somebody doing that job when they could have this really cool job? So I think that overall it's likely to be really positive for the economy. But we're going to be in a period over the next few years where there might be some significant dislocations, and that's something to worry about and watch for.
Sticking on the job market for the current job market, so the lack of job growth in the last 6-9 months, you mentioned labor supply, you mean the immigration and the fact that the number of foreign-born in the labor force is actually declining. You mentioned AI is having some marginal impact. Anything else? What else is going on there, do you think?
I mean, there's a cooling in demand outside of the tech sector.
Right.
And so job growth has been more concentrated in things like the healthcare sector. And so the labor market is kind of cooling, has been cooling. And then the question is, where are we in that balance? And right now, we're about creating the number of jobs in our economy consistent with a break-even rate. Again, maybe a little bit below. This month, maybe last month, maybe a little bit above. So overall, the labor market is in kind of a rough balance, but it's in balance at a pretty low level of net new job creation. And so, that creates some risk that if the country gets hit with a supply shock of some kind or a demand shock of some kind, that we could see further weakness in the labor market. And that's, I think, why you've seen us, over the last year or so, pull interest rates down about 150 basis points. Now we're, making judgments about whether the risks to inflation are higher than the risks to the labor market. I am concerned that we're seeing inflation still at around 3%, and our target is 2%, and we're committed to getting to that 2% target. So we need to be careful and cautious now about monetary policy because we want to make sure that we're achieving both sides of our mandate, that we're supporting the labor market, but that we're bringing inflation all the way down to our 2% target.
Here's the thing, though, bringing it back to AI that I can't get my mind around. I mean, if we're not creating any jobs, and if AI is only playing a marginal role, and if, like we all anticipate, AI is going to play a much bigger role in affecting job creation, and it's going to be a weight on jobs, aren't we going to start seeing some significant job losses here, as we move into next year?
I think that's the question. In 2026, what are the balance of these three kinds of labor market effects? So we're going to see some job losses. We're going to see some increases in productivity in existing jobs that's going to permit people to better their lives and improve our economy with potentially higher rates of productivity. And we're going to see some new jobs created. And the question is, what's the timing or sequencing of those things? I don't know. So one of the things I've been trying to do is think about different kinds of scenarios. Since it's very hard to forecast in this space because it's changing so rapidly.
By the way, I try.
That's why I mentioned it. I think it's easier to think about these different kinds of scenarios and say, okay, if this scenario plays out, what do we think the labor market effects are? If this scenario plays out, if this scenario plays out, labor market effects, growth effects, productivity effects, and we'll have to see that as it unfolds in real time.
So, and this goes to your speeches. I think in the 3 speeches you talk about these scenarios. Yeah. In my interpretation of the way you're framing this is you've created these kind of bookend scenarios, that kind of are opposite ends. The one I call the, I don't know if you call it, if you've got names for the scenarios, but I call it the incremental scenario, that adoption of AI isn't, it's more modest. It occurs over a period of time, sufficiently to allow the economy to kind of adjust to the adoption. And then the other, on the other end of it is, use the word revolution. You know, this is very transformative, big changes in the way we operate and the kind of, you know, labor, how much labor we need in the labor supply. And those 2 things kind of bookend the, so is that, did I get that roughly right?
That's right.
Okay, I read that correctly. But neither of those are your, if you had to pick a baseline, you know, what you think is actually going to happen. I mean, if you know, is it closer to the incremental scenario, or is it closer to the revolutionary scenario, or something in between?
I think it's likely to be something in between. You know, when we've looked at the technology adoption in the past, we've had waves of really serious technology adoption. You know, if you go back to the steam engine, well, that took sort of 100 years to filter through broadly into the economy. If you think about the tech revolution of the 1990s, that took maybe a decade. This is going to be shorter than that. So the adoption is likely to be shorter, but it does take some time. There are huge changes in organizational culture and in organizational behavior that have to happen for the technology to be broadly adopted in companies. And in the short term, that's likely to reduce productivity because you're making a bunch of investment, you're not yet getting the output. But that transition is likely to be shorter. It's likely to be much shorter for big companies. So when you look across sectors, you know, big companies are adopting generative AI quite quickly. Smaller firms, not really at all, or in much more limited ways. So there's going to be a little bit of that tension. There's going to be tension across sectors. So in, you know, financial services has moved, we were moving very slowly last year and are moving very quickly this year to integrate AI into their workflows. So kind of sector by sector, you're going to see a lot of variation in the short term. And, you know, in some sectors, you know, consulting, you might see significant retraction in the number of workers, at least for a period of time. And in other sectors, you might see, you know, growth.
So if you go to the incremental scenario, this is adoption, but slower adoption.
Yeah.
It feels like to me the risk there, near-term risk, you know, next year or so, is the stock market, right? I mean, investors they've juiced up equity prices to a very significant degree. By any tried and true measure of valuation in the equity market, it feels highly valued, you know, bordering on whatever you want to call it, overvalued, so forth and so on. Investors are expecting a lot. They're not expecting the incremental scenario. It doesn't feel like to me. So if we get the incremental scenario, it feels like there's a potential for a significant correction in equity prices.
So, you know, I'm super careful not to comment on the appropriate level of the stock
market. But I still can
ask. You can ask, but I won't say what I think about the appropriate level of the stock market. But you know, I do think it makes sense to use this scenario-based approach to think about it. So, you know, this huge amount of investment is going into this sector, and you have to think about the, you know, average life of a useful life of a chip going into a data center. You know, you can think about that as being 3 years. Maybe you can stretch it to 5 years, but new technology for chips is moving so fast that you've got to replace those pretty often. So that suggests that you need pretty widespread adoption to use the planned capacity. Now, so you have to think about that and try and judge whether these things are going to line up with each other in timing. And as I said, I don't know what the timing is going to be. The other thing to keep in mind is that partly these companies are racing so fast because there will be winners and losers in the race. And if you believe that there are likely to be only a handful of models that are successful at the end of the day, and that become ubiquitous in world markets, you want to be that firm, even if it means that in the short term there might be, demand might not be fully lined up with the supply of chips.
Got it, got it. But just to summarize, you've got these two bookend scenarios that kind of give you a sense of where things can land. But the most likely scenario is something in between where, and that would be consistent with history and technology, that the adoption is slow enough that that we can all adjust to it, and it's not dystopic in any sense of the word.
So I think that's my kind
That's
of
your sense of it,
my sense of it. I'll say if you talk to some people in the labs, they have a very different view of how this will play out. So, for example, some people in that sector say, well, you're thinking that the dominant model is that humans incorporate this technology into human organizations. But maybe there's a world in which AIs manage other AIs in an AI organization, an AI firm. And that AI firm is competing against a human firm. And maybe the AI firm will win. And then the adoption will be much faster into the economy. So that's sort of a different vision.
Let's do the revolution scenario.
It's a very different vision for how this might play out. Right. That's not my base case of how the world will look, but I do think that you have to take seriously all of these scenarios.
One other thing before we move on, because I want to talk about the implications for monetary and regulatory policy and maybe even systemic risk, but what about
let me ask you, what's your base case?
Same. Yeah, because I'm an economist. The way I forecast is I look at history. I say that's the analog I'm going to use. And if I look at the internet as my most recent analog, and technology diffuses slowly. It only diffuses, and I'm speaking to you now as a business person at a large multinational that is fully in full swing on AI. That technologies are only adopted when new businesses form and optimize around the technology. When legacy companies, big legacy companies try to figure this out, it's very hard. I'm just saying. So I listen to the technologists and I go, you're not running a business, So I hear you. But the other concern that's come up, and it's in the context of the rise in equity prices, and the fact that the winners here, it's winner take all you kind of describe, is the worries about income and wealth distribution. Which this has been long in the making, and here we are, and it just feels like this thing is intensifying. This so-called K-shaped economy. Do you worry about that?
I do worry about that. We are, I think, even aside from artificial intelligence, in an economy right now where it's much harder for low and moderate income people to get by. They don't have that wealth that upper income people are sitting on. I want to make sure that as we're thinking about the future, that we're thinking about a labor market that can serve everybody. Now, AI could, it won't necessarily, but it could, if we're intentional about it, help actually make that better. So if AI, for example, can be used by people with lower levels of education to improve their productivity, and there's some evidence of that, then that gives them a channel through which they can improve their wages over time and kind of move up the skills ladder to higher wage positions. So there are ways in which AI might help. There are other ways in which AI might exacerbate the problem because, as you said, if we're in a winner-take-all situation and capital becomes much more important than labor in that equation, then the returns to capital will go up a lot, and people who have invested will get much, much wealthier. So the wealth distribution might change significantly.
Okay. We're running out of time, so we're going to pick up the pace here a little bit. Monetary policy. So how do you think about all this in the context of setting interest rates? To be frank, I'm kind of confused because there's all kind of cross currents here. Theory would say if you are generating all these productivity gains, higher potential growth, your equilibrium interest rate, your R star, your neutral rate, that rate at which policy is neither restraining or supporting growth is higher. But on the other hand, if we're talking about higher unemployment because of dislocation in labor markets, and it's a positive productivity shock and lower inflation, that would argue for lower interest rates. And when we go back to the internet period when Greenspan was chair of the Federal Reserve, he kind of focused on, he actually kept rates lower for longer, right? Because he was more focused on, the kind of the positive inflationary effects of that. How do you think, am I framing that right?
Yeah, I think that's the right set of things to think about. First of all, I think it's helpful to separate long-term, short-term.
Okay.
So let me start with long-term and extrapolate away from the current set of circumstances. So long-term, R star, the neutral rate, has been coming down steadily for many decades. And those factors that have brought R star down over those decades are still with us. There are big changes in demographics and in the flow of savings around the world. So the question is, how much does this AI change alter that view of R star? And I think it might. So if, as you suggest, if productivity is significantly improved and returns to capital are significantly higher, that would suggest a somewhat higher R star. Again, keep in mind this long-term downward trend that hasn't gone away.
Right.
So in relative terms, that would be somewhat higher. And then you have to balance that with what do you think is going to happen to the labor market, because we're a dual mandate institution. We're supposed to promote maximum employment and price stability. And then you have to ask, well, what is going to be the rate at which we can also promote maximum employment? Our tool is a very blunt tool. We have only really one major tool, and that's to adjust the rate of short-term interest rates. And one question is whether that tool, which is quite well suited to cyclical changes in the economy, has really anything to do or say about big structural changes in the economy. Okay, so that's long term. Then short term, we're in a situation right now in which both of our goals are potentially at risk. Unemployment has stayed historically low, but as we were talking about earlier, net job creation is also very low. So there's some risk to the employment side of the mandate. And inflation, which has come down a lot from 2022 when I joined the Federal Reserve Board and the FOMC, come down a lot to about 3% now. But it was going down steadily until the spring. It looked like we were going to be on a very smooth path towards 2%. And beginning in the spring with changes in tariff policy and other factors, it started to climb back up, and it's now at about 3%. So we need to see that get all the way back down to 2%, and that's why there's some tension in our goals now, and why I think we need to be cautious about how we're proceeding from here.
Got it. Well, let's end our conversation with what all this means for kind of a regulatory policy and maybe systemic risk. Maybe we can combine the two. And there's some increased. When I think about the potential systemic risks, I think of two things. Mm-hmm. One is increasing amounts of leverage coming into financing, the infrastructure development. You hear the words private credit, private equity, and they're providing a lot of the leverage. And the second is trading. Mm-hmm. That with we know the downsides to algorithmic trading. It creates a lot of volatility, and you can get big dislocations in markets, very quickly. Are those the kinds of things that are on your radar screen?
Yeah, I think those are the two, the two big things I would highlight. As I mentioned before, most of the investment until this year was equity. And now there's a bunch of debt flowing into this sector. And so depending on how the demand-supply factors work out, there could be a shock there. But I think more fundamentally, there's this question of what happens when generative AI machines are trading with other generative AI machines. We have machine learning trading going on for many years now in most of our trading markets. They're dominated by machines trading with machines. So it's not new in that sense, but if we get to the point where we have agentic AI determining its own trading strategy, rather than a machine trading on a human trading strategy, you could have additional risks. So you've got the speed of these machines is awesome, as they are today in algorithmic trading. But you're adding to that potentially two other things. One is ubiquity. So if everybody is using models that are fundamentally similar to each other, that's a problem. And then you add to that automaticity. You take humans out of the loop, and if you've got agentic AIs determining trading strategies with each other, you could get market collusion, you could get market manipulation, and you could get much higher volatility if the agentic AIs decide that you can make more money in much more volatile markets, and all the AIs decide that together. That could lead to significant problems in the markets.
So we're going to have to call this a session, but is automaticity a word?
I just used it.
That's a great word. That's a great word. The other thing, just so everyone knows, Michael doesn't know cursive. Yeah, I don't know what that means, but anyway. But it was a pleasure.
Yeah,
Thank you for
great
the
to see you,
time. I
Mike.
really enjoyed it.
Yeah,
Thanks, everyone. Thank you.
Nicely done.